Hello and welcome to another live episode of Smaulgld live stream. Today is July 31st, 2018. It is Tuesday. Tonight's episode is called Consumer Sentiment and the Gold Price. And we're going to cover the impact that consumer sentiment has, or lack of impact perhaps, the consumer sentiment has on the gold price. And I've got a dozen or so indicators, and none of them are too reliable. I'm going to rattle them off, discuss them briefly, and see if we can get some comments and discussions, because I don't think there is a reliable indicator. I've been talking about how it's very hard to say why Bitcoin would rise. Bitcoin has no earnings. Bitcoin is just there. Well, it's similar to gold. I'm going to go through those, but before we do, some of the indicators, let's find out what happened to the price of gold today. Pretty much flat again. It's hovering in the very low 1200s, opened at 1220, hit a high at 1227, and currently is at 1223. The story with silver, not much better. Opened at 1540, dropped all the way down to 1534, peaked at 1557, and is at about 1548 at the moment. The regular equity markets, Dow closed up 108 points. NASDAQ had a decent rebound, 41.78. And the S&P 500 closed up 1369. As to news, there wasn't really much today. I think President Trump is giving a rally that may cut into our audience tonight. For those of you MAGA fans who watch the Donald Trump rallies, I was watching it earlier. Much like all the other rallies, he's focusing on the steel increases. But one thing I did catch him say, and this is something I started talking about in 2014. I think I wrote a blog post, "A Black Swan Emerges Covered in Cheap Oil" was the name of the blog post. And I was talking about what would happen if the United States actually fulfilled its shale oil projected boom, that at some point the U.S. would become a large oil producer, and with that, perhaps a large oil exporter. And I was looking at that from the perspective of death of the petrodollar, and the idea being that the petrodollar, that Saudi Arabia priced its oil and only sold its oil in dollars, and if they stopped doing that, then it would be game over for the dollar, end of dollar hegemony, and so on. And I thought, well, I didn't really believe that in the first place, because that's not the only reason central banks hold dollars as the reserve currency. But okay, fair enough. That's one of the underpinnings. Certainly was the reason that the dollar didn't lose its status when Nixon went off the gold standard in 1971. But then I was thinking, if the United States became a major oil exporter, well, then the concept of needing dollars to buy oil would still apply. And even if Saudi Arabia somehow lost that special relationship with the United States, well, they still need to hold dollars in reserve so that they can buy oil from the U.S. Well, Trump was saying today that the United States is now the largest energy exporter, and that includes natural gas and oil. So the idea, the death of the petrodollar, is an outdated concept, I believe. It was even outdated before the U.S. became a major oil producer. Even more so outdated now, because not only is the dollar, quote, backed by U.S. oil, meaning countries need to hold dollars in reserves, including China, to buy oil from the U.S., but they still also need dollars to buy oil from Saudi Arabia, because Saudi Arabia hasn't shown any sign of, since Trump's been president, of moving away from that special relationship. In fact, Saudi Arabia was really furious in 2016 when Congress passed the 9/11 bill. And also, they weren't too happy when the Obama administration did the Iran deal, because the Sunnis and the Shias really hate each other, and the United States was supporting Iran. Well, now the United States undid the Iran deal, so you could say that Saudi Arabia is back in the orbit of the United States. And between Saudi oil and the U.S. oil, there's your petrodollar right there. All right, let's look now at some of the rationales. So what you see on your screen, let's take a look at this screen, is a chart I made. Now, I'm trying to focus on indicators for gold since the financial crisis, because I think the world is a different place. The reason the world is a different place is not just its pre-crash, post-crash, is the response of the central banks. You had 5 years or 4 or 5 years of QE from the United States. You had all central banks, including the Fed, bringing rates down to zero. You had Bank of Japan, you had ECB, all doing QEs, buying corporate bonds, buying sovereign bonds, buying each other's bonds. And then you had China, who went into hyperdrive in 2009 as well. So all the major economies went into the massive print. Now, before we look at the chart, let me go through some of the other indicators that you may look at, or data points, and think about some of the ones that you like, or the ones that you think are valid, the ones that you think would help you predict or at least track the price of gold. So some people look at interest rates. It's fair enough, or real interest rates, the spread between the rate and inflation. Some people just look generally at gold supply and demand, meaning how much gold is being produced by miners and how much gold is being demanded by people wanting to consume it for jewelry, for investment, or central banks. Some people try to measure gold by political uncertainty, geopolitical risks, things like that. For a while, there was this whole yen-dollar relationship. That's switched now to China is controlling it with the yuan or the SDR. There are periods of time where there's correlations, maybe not causations of these relationships, but clearly there's something to look at as well. There's central bank buying by Russia, China. There's imports into India. There's the open interest on the COMEX. People look at that. People look at the amount of ETF flows. Others might look at gold versus the GDP. Others will look at jewelry demand. One that works really well is the relationship between TIPS, the Treasury Inflation Protection, those bonds that you can buy that pay you more if the inflation rate goes up. They're very tied, they seem. I'll post a chart on that tomorrow, to the price of gold. But if you go through all of them, I'm just going to quickly go through all of them. We'll spend a little time on the consumer sentiment. Supply and demand, physical gold supply and demand, I don't think tells you much. Clearly not short term, and not even in the midterm, and especially it's the same with silver, because you can have deficits for a while and that doesn't impact the price. When Russia buys a lot of gold, it doesn't do anything, and I constantly point this out. When people say central banks are buying gold hand over fist, the amounts that they buy are not that much. So what Russia buys is not a large amount, even though it was a record 224 tons last year. That's less than 7% of overall global mining production of just 1 year. So it's not going to have that big of a difference on a metric that doesn't have that big of a difference, meaning the physical supply and demand of gold doesn't seem to be what drives the price. More likely what happens on the COMEX, more likely what happens maybe with flows in the ETFs. That might influence it more. But the physical supply and demand doesn't. So I wouldn't expect when Russia buys gold that the price would do anything. And indeed, a point I make a lot is that India's gold imports are 4 or 5 times the amount of gold that Russia buys, and that doesn't move the price either. Clearly buying U.S. Mint, the amount that they sell at the U.S. Mint is de minimis. That's not going to have an impact. So I've ruled out gold supply and demand, physical supply and demand. I don't care whether it's Chinese, Kazakhstan, Kyrgyzstan, Turkey, India, Russia, whoever is buying gold and people are touting someone is buying gold hand over fist. So what? That is definitely a so what, because, or sovereign size gold buy in 44, whatever that is, those amounts have never moved the price of gold significantly or even modestly. What moves the price of gold is going to be something that happens on the COMEX or some type of event. But those are short-lived too. So then I started looking at other things to see whether you can... See, you can't predict if there's a correlation. You could just track, which is... You really can't predict where the value of a currency like the yen or the yuan or the SDR, basket of currencies, are going to go. So that's not really a good predictor. You could just point it out and jump up and down and say, look, there's a correlation, but it really doesn't mean anything. Same with the Treasury, the TIPS, the inflation protection bonds that they sell. That just tracks it, but that tracks it pretty good. So you could say there's a correlation between gold and inflation. But the reason I also look at things since 2008, and I want to be more recent, is what I mentioned the other night, which is the monetary portion of gold is not 90%. Meaning, it used to be gold was money, period. And when it was part of the financial system, the Bretton Woods system, it was $35 an ounce, and it was $35 an ounce for decades, and that was it. And they were trying to keep it as a stable price because they didn't want to devalue the dollar. But once they let gold float, for many years, I would say decades, gold was considered the anti-dollar, meaning that it floated in correspondence to the values of the fiat currencies, because especially for the first 5 years, the European banks were still shell-shocked and thinking they were going to go back on some type of gold standard. The world still thought of gold primarily as a monetary asset, and trinkets and jewelry, fine, but there wasn't as great a demand back then, because what really spurred gold demand in the last 20, 30 years has been the rise of India and China, and not because they're buying bullion as much as they are buying a lot of jewelry. So the demand for gold and the way gold is used, it's not as much, and you can see it in the charts. There's not the same correlations I think that they once had when gold was considered money. You see it in the last 10, 15 years when there's geopolitical risk and there's issues. It doesn't spike in the same way that it would have done in the late 70s, early 80s. Korean jetliner goes down, boom, up goes the gold price, and so on. Also, GDP is an interesting one. We talked about this. When you have rising GDP, as we had decent GDP years in the Reagan years and the Bush years, and you had relatively low inflation, you still had rising gold prices. And that could be because, but I'm not sure it is, because of physical gold supply demand. There was another one that worked like a charm. Two of them that worked from 2008 to about 2013. And that was the money base and also the amount of outstanding U.S. debt. There was a straight correlation, it seemed, up to about 2013. And while the base money continued to rise after 2013 and the outstanding debt continued to rise, the gold price did not. So I have to check that one off the list. Now you could say, well, it's going to come back. It's been 4 years, so for it to come back, it would have to do a hockey stick straight up. I think once you lose a correlation, it either creeps back. It doesn't. I don't think it comes roaring back. But I'd like to get your thoughts on that one. And so let's then take a look now at the chart. The consumer confidence is somewhat tied into inflation. If you don't have inflation and you're doing well, I suppose they're tied in. But if you look at the chart, well, before we look at the chart, we have a Smaulgld subscriber living in Australia. I won't say who, but he thought that the shipping was prohibitive to buy a Smaulgld mug. So he made one himself. You could see there's actually a plastic cup. I don't think that qualifies as a mug. But anyway, those are, you can't see, I'll put a bigger picture on tomorrow's blog post. But those are Australian kangaroos, silver kangaroos, and he can put those silver kangaroos in his Smaulgld mug. So I thought that was a clever way to prepare for what's coming if you can't get your hands on a Smaulgld mug. I guess ceramic mugs are the gold standard, super classic, and a plastic mug is silver. All right. Now let's look at this chart that I made. The blue line is consumer sentiment, and that is a University of Michigan metric, and it's based on a I think it's 0 to 100, or because it's somewhere in that range. It can go over 100, but what I had to do to make the chart work, I had to add a 0, because gold was starting out around 900 to 1,000. You can see it went up to 1900 in 2011, and in order to make the chart not totally separate and to somewhat track, I added a 0 to the Michigan number. So instead of it being at the very end next to the mug, 98, that would be 980, but it's the same thing. So it's on a base 10 scale added. Now if you look at it, there's somewhat of a correlation. You could see the gold price from 2008 to 2011 go straight up, and can't really say that the consumer confidence was going down then. It was coming back from the financial crisis of 2009. Things were getting better because the media kept saying they were, from 2009 and 10. So if you look in the first box, it went down and there was somewhat of a correlation, but then you can see halfway through the box, 2009 and 2010, consumer confidence was increasing as the gold price was, and the gold price was increasing much faster. Then if you look at the next box, 2010, 11 to 12, that's when the gold also hit its peak. And yes, indeed, you could see the lowest point on the chart. The lowest point on the chart for consumer sentiment is down around 560, that blue line where it spikes down. And that correlates to the highest part of the gold price. So there was somewhat of a correlation there. And then you can see from 2012 to 2014, you have pretty much a nice increase ever since. You've seen since 2012 to 2014, it ended up higher. From 2014 to 2016, and then you see where we are now, it's gone up. And essentially, you've seen a decline of the gold price since then, with some peaks. And so it's not an exact correlation. So you could say that there's enough of a monetary connection between gold and inflation, and gold and consumer confidence, that you might want to track that. But again, it's not perfect. It doesn't, you could have a month or two where the consumer confidence is skyrocketing, and maybe gold is going up too. So it's hard to tell, but I want to see what you think. I'm not convinced there's any one way. I think it was a lot easier in the 70s to track gold, what was happening. But I think now, even with debasement of currencies, it clearly hasn't impacted silver, because silver is lower now than it was in 2007, and there's been massive money printing, massive debt, and that has not helped the silver price. The gold price has gone up since 2008, 7. It was $800. It's $12.50 now, $12.20 now. Silver's the same price, so it's hard to say that silver maintains any real connection to the financial system or the monetary system, and you're going to have to come up with other reasons why silver is where it is, other than manipulation. See, manipulation can only retard or impact a direction, but I don't think it might, because silver is such a small market. Maybe it's just totally squashed it. But I do think that silver doesn't have the connection to the monetary system, so shocks to the system, inflation, rises in consumer confidence, I don't think impact silver. I think what impacts silver is COMEX and somewhat supply and demand, but even there you have these deficits in silver, which you would think would make the price go higher, but it doesn't. All right, let's look at the comments, because that wasn't meant to tell you anything. That was just meant to give you some thoughts on what may or may not be correlative or causing gold prices or predictive of gold prices. So Pad says we'll have a flash down around 1700 on which will trigger buying. Now, when we've seen that type of thing happen, you do see the buying, and that usually reflects a bottom. That's what happened in 2015. You had a big year in Silver Eagles. You had a big year in Indian imports, and all that buying kind of catches up with it, and then the price does somewhat of a bounce off the bottom. So that could be a good play, 1170. Shark Air, the last day of the month, gold was on a wild ride. Silver went nowhere, which is strange because normally silver is more volatile. Pad, 80% of fracking oil is spent in the first 2 years. There is no way to get an exporter for very long fracking oil. Well, now I've seen and I've seen people saying everything on this, and I'm not a geologist, and I don't even think even geologists are sure, but I have seen studies that say that U.S. fracking oil will peak in about 15 years. Others are saying it peaked already, so who knows? But I'm looking at the current numbers. I've looked at them for the last 4 years. I tracked them monthly. They're doing nothing but going straight up. So in the short term, I don't think they're going to stop this month, next month, the month after. So you can only play month at a time. And yes, you're right. You shouldn't count on permanent geopolitical realignments based on something that may not be around in 5 years. But who knows? All right. The big political questions, says our Dr. Modesto Esquire, is whether U.S. is going to isolate itself from Middle East if it's oil independent. I don't think so, but it's a good question. There's a huge number of Americans who've had up their eyeballs with the Middle East. Yeah, excuse me. I still think, though, that the U.S. is drawn politically to the Middle East because of Israel. So I don't think they can just say, oh, all we're going to do is worry about what happens to Israel. There's too much worrying about what happens with Iran, and then they have to worry about what happens with Russia, and Russia wanting to be involved in Syria, and then what China wants to do, and Saudi Arabia. So unfortunately, I don't think the United States can extricate itself from Middle East politics, but you never know. One theory is the fracking oil will buy time until there's a large percentage of electric vehicles. That's another good point, but then you have to wonder, what about, these are all still resource driven. The electric cars are going to be based off of cobalt and lithium, and those are not in tremendous supply. So yes, energy is something to keep an eye on, and everything's changing. So that's why when people say petrodollar, Saudi Arabia is almost a spent force. I mean, it's not the same as South Africa for gold. These countries were once geopolitically important, and they're not so much anymore. All right. Pad, the Middle East is already pivoting to China. Maybe not now, but give it 18 months. Yeah, that's something I think they say a lot, but China has got a lot of pivoting province on its own. You know, you may see China retreat to itself. China has huge internal issues, massive debt. They can't be expanding themselves around the world. We're seeing, I'm not even sure that contract that was canceled, they say by, in Malaysia, was contract by Malaysia. It might have been canceled by China. China has got a declining economy. They're shutting down 2,200 factories. They could be finished as in the sense of expansion overseas. They may not be, but there's this assumption that somehow China's just going to march through across the East and into the Middle East and into South America. All this costs money. They don't have a reserve currency. The countries that have it don't want it. They don't have many in reserve, so they got to print the yuan. They got to debase the yuan. The China story is complicated, but it's not too complicated to see how it's quite possible that they may have already passed their point where printing money and borrowing money does them any good. All right. I like the garbage index. Can't rig the garbage index. The less people are throwing out, the less they are buying. That is an interesting one. Now, one could argue, though, if you put in these straw taxes and so on, that people will be throwing out less stuff, not because they're consuming less stuff, but maybe the packaging is getting less. But it is an interesting thing to look at. It's good to look at all these things, but I think there's so many things at play, it's very hard to tell how all these in the aggregate or individual can predict or indicate a gold price. See, people insist, oh, it's got to be, for a while it was the yen dollar. You know, these correlations are not necessarily causations. They could be temporary. They may be predictive for 2 years, but maybe they don't last. All right, Gusta Broken is in. Cash flow. There you go, cash flow. What grade $20 double eagle coin would you buy? Well, I don't buy them, but I think right now, but I do track the prices of all this stuff. The double eagle coins in the, I think it's the very good condition, can be had for pretty much the same price as a gold eagle. And a gold eagle, though, is 91.67% gold and is in an ounce. And the gold, the double eagle is 90% and it's slightly less. So you're getting a little less gold pure ounces with the double eagle. But there is some numismatic value on a double eagle. So one could argue if you can get it for a slightly better, what's the word? Better grade, then you might be better off. But a gold eagle, I think, has 0.96 ounces, and a American gold eagle has 1 pure ounce of gold, and it also has a little copper and silver. Not a little. I mean, it's 91.67, so it has a little base metal for the color and the durability, but and some silver. But the double eagle has 10% copper. So I think you have to buy those opportunistically if you like those and you think you're getting almost an ounce and you're paying about what you pay for an American gold eagle. I mean, they're expensive, but if I was going to buy, I would want to have it just to have a historic memento. I'd like to have one of those double eagles. I think to the St. Augustine's, I would like to have that as opposed to a big American gold eagle, because I wouldn't sell it. See, if you that would be to have as a collector's item, and I clearly would rather have the older coin. But if you're going to buy stuff for investment, it's 6 of one, half a dozen the other. Well, maybe you're getting a better benefit because you're getting, if there's less interest in coins right now, you might be able to shave off the numismatic premium and get it close to the price of the American gold eagle. All right. I like following Charles Nenner. You know, I haven't followed him. I saw him once or twice, and I remember liking him, but vaguely. I don't remember his input, but he was on Greg Hunter. He does not believe in free will. He trained traders at Goldman Sachs. He seems to be right 70% of the time. That's a pretty good... I mean, most of the people in the gold space are wrong 90% of the time. So if he's right 70% of the time, that's pretty good. And I think the reason they're wrong is just because they're looking to make a home run. So everything they see is going to be a game changer, shock the world, you know. And they just figure they just keep taking swings, and maybe they will hit a home run one day. Gold is going down, the dollar is going up. Yep, that's, you know, there is that. But there's times when both can go up at the same time. You know, because if they're both considered safe havens, then it's not necessarily the anti-dollar. So you never know with today's world. It's not as easy to figure out what's going to happen to gold based on the dollar. Garbage index. Pat, I'm now hearing mining CEOs say they do not believe we will break out of this range until some crisis. 1360 to 1212. These are fibs. Well, mining CEOs, I mean, they're just as bad as anyone else in trying to predict the price. All right, Dr. Benesto is talking about the freight railways data put out by the American Association of Railroads. Interesting. Hugs to all mugs. Yes, we still got mugs. I will do a mug shipment tomorrow. I did not go today. If you ordered, it will be, you've gotten an email from me. You will be getting your shipment tomorrow with your tracking number. And I hope our Australian friend is not trying to sell those plastic knockoffs. All right. Pad, because of the influence of the Treasury, Fed Reserve's exchange stabilization funds, I don't see anything as a good judge of gold's direction. That could be. I mean, if you're going to have enough manipulation, they don't have to manipulate it every single trade, every day. But if they manipulate it directionally, according to how they want, then it may have no correlation to anything that you're looking at it. Yeah, it could be in astrology. Now, Pad, you say there's no way the metals will be in this range for 18 months from now. They've been in a range for 18 months, about approximately. This has been the least volatile they've been until like the last 6 weeks, where they actually fell pretty hard. But before that, they were pretty much in a range. Why do you think that they won't be in this range? Gus the Broker says interest rates have gone into the negative in the EU. Yep. So gold on the rise. No, exactly. Now you would think they should be. That's why that correlation doesn't work. You would think, sure, gold would go higher. You got negative interest rates. You have some level of inflation. That would be, if you put that into your magic formula, that would say higher gold price. It doesn't. Uh-oh, pad with the Masonic order for the last 100 years. All right. Dollar high, gold low. All right. Melissa Hauser is in the, she's in the Hauser. What if Fed were forced to reverse course and do QE again? Could that scare some people into gold? Well, go back, not that history is indicative of what might happen in the future. The first QE is basically what shot gold higher. Second QE went even higher. I did a chart on this. What happened with the first QE was it went up, it went up, it went up, and then they start talking about stopping it, and then it goes down, and then they stop QE1, gold price goes down, then they start QE2, gold price goes back up, and then after a while they start talking about stopping it, gold price goes back down. But when they announced QE3, and it was to be the biggest one yet, I said to myself, that's it, this is nuts, this is 3 in a row, this is 3 strikes, you're out. And that's the one that didn't break the camel's back. That's the one I was talking to you on early in the program, where the monetary base and the debt continued to rise, but then gold did not follow. Now, one could argue that's when the ESF or whomever decided, enough of this, we're not going to let this be a self-fulfilling prophecy, because remember, from 2009 to 2011, gold and silver went straight up, and they were doing massive QEs. And what they were trying to do during that time period was not get people to buy gold and silver. They were trying to get people, they were trying to revitalize the housing. They were trying to revitalize credit buying of cars, housing, and they were trying to get people to buy stocks. And it wasn't working. I think QE3 turned the corner, and I think, let's say there wasn't manipulation, and this is possible. Let's say there wasn't manipulation, but that the massive size of QE put the risk on. It's kind of odd if you think about it, but not really, because when you're doing QE, the prudent and conservative people say, oh, this is reckless. I better get into gold because this is going to cause a collapse. That's one view. The other view is, no. When the central banks do QE and lower interest rates, it means risk on. Not risk on. It means go and buy stocks and real estate. So it's hard to say. So if the Fed were to get up to 2.5% interest rates and we have some type of crash or some type of financial shock, I think what they would do, I think they would ask the Congress for the ability to buy stocks. And then again, if they were to do QE4 that had stock buying in it, well, guess what would happen? Stocks would rise and gold wouldn't go anywhere. I think they have it in no matter what. Like your initial reaction would be, yeah, I better buy gold because QE4, this is it. This is the game over. And it depends on the tenor of QE4 if they do it. And the other thing is, I don't even think people think. They just think they can keep printing forever. And who knows how long they can print. So I thought QE1 and 2, you looked at those, you said check, check. And when QE3 came along, that to me was check plus 4 and didn't materialize. The premium on pre-1933 coins are too high again, so I'm back to Eagles. Yeah, I don't follow it that much, but I know if it depends on where you buy them. Because if a coin dealer isn't going to pay somebody anything other than close to spot for an eagle, the historic ones, you might be able to get one for the price. So it depends. Depends on what you want. If you're a collector, you don't mind paying a few extra bucks. If it's really significantly higher, or you're going to buy a slab coin, I don't know. I don't think that they are. I mean, I think that's a collector's item. But I mean, people. I think if you want to trade the gold price, you do the GLD. Well, that's just the price. That's not to have gold. That's just because if you think gold is going up, then that's the best way to buy and sell it, because you're going to get your value right there if you want to turn it into fiat. Or you can take the profits. You can go buy whatever you want. You can go buy Eagles with the profits. All right, Pat, in 18 months, we'll be... Oh, I see. You're saying we'll be through the midterm, right? Well, that'll be done in 6 months. Plus, it'll be 18 months more sanctions on China, assuming that the tariffs aren't over by then. But, okay. 18 months deeper into that. That's almost undoubtedly, at best, you might get a slight reduction in the debt because maybe the tax cuts produce more revenue, but nothing significant there, you're right. Plus 18 months higher interest rates or 18 months into QE. Well, most likely from now and the next 6 months, you're not going to get closer to QE. You're going to get closer to 2% interest rates because they're going to raise rates unless something happens. But all right, well, those are good things to keep an eye on for 18 months. Now, Pat says if Congress authorized stock buying, gold will go to the moon. Well, that's what I think originally, but not necessarily, because if you buy what the Fed is buying, you generally end up better off, because simultaneously, if they want people to buy stocks, if they think stocks have been beaten down too much, if they think that stocks are confidence, remember, they don't want people to have confidence in gold. They want people to have confidence in their markets, which are the bond market and the stock market. And if they had to buy stocks and bonds, and somehow the gold price was screwing that up, they'll throw resources that shorten it. So yes, your initial reaction would be, you're going to go and buy gold. This is crazy. They're buying stocks. You might say the better move would be just gold. Don't fight the Fed and buy the stocks along with them. We'll have to see if that comes true. I don't know. But there's two sides to that. The obvious gut knee-jerk reaction is this is crazy, go buy gold. But if you did that in QE3, you got hurt. If you'd gone with the nonsense stocks at the time, all the FANGs in 2013, Amazon, you made a fortune. SD Bullion. Yeah, SD Bullion, yes. When I do my affiliate, they do seem to be lower than the rest. I wonder what a Democratic Congress would do for the price of gold. Well, here's the consumer confidence thing. There is a theory, and people have... It's Steve St. Angel. He subscribes to this. I kind of do too. That Obama was a gold salesman. People thought that Obama was going to take your guns. People thought Obama was bad for the economy. The consumer confidence was lower. Now it's higher under Trump. People are less worried. There is that concept that ties into the consumer confidence going higher, gold going lower. If Democrats were in the Congress and controlled it, they bring impeachment proceedings. They won't pass, but I mean they can bring impeachment. They're not going to get 2/3 votes against Trump unless they actually find something so damning on him. That creates political uncertainty, but probably not enough to make people nervous, because I don't think, remember, whatever the Democrats want to do to undo what Trump has done, they can't, because he's going to veto it. So even if the Democrats take the Congress and the Senate and the House, they're not going to get 2/3 votes in the House and 2/3. So they're not going to be able to pass anything or undo anything. And then, if people are unhappy, it's possible that in 2020 it flips again. So I'm not sure that a political change is going to influence very much the price of gold. But we'll see. Spot prices, buy both stocks and gold. Yeah, you see, that's the thing, Pat, that I think a lot of people didn't catch on to. They thought it was either or. And I think in hindsight now, gold was the insurance, not the rocket ride. And the stocks were the rocket ride and the gold was the insurance. And that's probably how it might play out this time. All right. I want to thank everyone for listening. Unless you've got any more questions or observations, I'm going to sign off, and I'm going to leave you before I go. If you want to get your Smaulgld mug and you want to order it tonight, I will get those out early morning, not early morning, late morning, early afternoon. Also, there's some new products in the Smaulgld store. Now, these are nice products, and if you like them, they're good to have. As you know, everyone needs a mug. Mugs are solid assets. They also help out the site. And if you're really interested in helping out the site, you can consider becoming a Smaulgld patron, which I have about a dozen of those. I'm very happy for that money coming in. I think it's about $50 a month, but it does help. And I'm going to leave you with that as well. I really do appreciate everyone coming out and listening. Have a good night. Remember, tomorrow night we'll be here at 8 o'clock Eastern Standard Time. Thanks very much.